And now going into question 8, we have Berry Corporation has 50,000 shares of 10 par common stock authorized. The following transaction took place during 2012, the first year of the corporation's existence. So they sold 10,000 shares of common stock for 18 per share, and they issued 10,000 shares of common stock in exchange for a patent valued at 200,000. And at the end of Berry's first year, total equity amounted to what? So the first thing you see here, notice that 50,000 shares of $10 par common stock are authorized. So just so you know, authorized means that you can issue up to 50,000 shares. Now nothing has been issued, it looks like, right? Because they're even saying it's the first year of operations. Now when they're saying they sold 10,000 shares of common stock for 18 per share, what do we need to know? What's the first thing you look at? Well, it says $10 par common is authorized. Okay, so you go back and you see how much cash did you get. All right, well it was 18 times 10,000. So we know we got a total cash of what? 180,000. 180,000. Now of that, a certain amount must have gone to par, right? Because par, we said, is what? $10 a share. Okay, so par goes 10 times 10,000. So this is our par value. How much goes to paid in capital? It's always whatever is beyond par. So if par is 100,000, then we got 180. So 80 will go to paid in capital. Now with this patent, they issued 10,000 shares in exchange for a patent valued at 200,000. So we're going to debit patent because now we have an asset. And how many shares did they give out for this thing? Also 10,000. Also 10,000 shares. So this 10,000 shares, again, I'm going to have 10,000 go to par. And par is at $10. So we're going to have 100,000 in common stock, and which is par, and then the remaining piece is going to go to paid in capital. So notice that, yes, total equity, what's going to be the total equity? Yes, total equity, I'm going to have now, this is 180 plus 200 is going to be 380. But notice where paid in capital is, and notice where par is. And in general, when you issue equity, the idea is that you're getting an asset. In this case, we got some came in cash and some came in the form of another asset, right? But that's both assets. Now, whatever goes on the other side of the balance sheet is equity. And this is how we're splitting up equity here in two pieces, is still equity. It's just that we always want to differentiate par from paid in capital. It's just the first layer, which is par, is going to be in there, and this whatever is above that is paid in capital. But whatever we're getting in cash or asset is going to be equivalent to your equity. So going back, let's see here. So we got 380,000. So we're going to have the answer is going to be D for this one.